Okay, I'd like to start out by thanking my co-authors, Sandra Huston, who was really the force behind this financial literacy assessment project, and John Howe, my dissertation advisor, who has, by the way, just reached the age of 60. He has now taken the ski lift up to the peak of financial literacy and is about to hit the black diamond. So what is the Financial Literacy Assessment Project at Texas Tech? There was a group of, by the way, Texas Tech is the biggest academic financial planning program in the world. And we had a bunch of professors that got together to suggest potential questions for a financial literacy assessment instrument. We started out with 89 questions. We were able to do a number of surveys and winnow it down to 16 questions that did the best job of sticking together as a construct to measure this idea of financial literacy. So it does have the highest scores in terms of construct validity versus other types of financial literacy instruments. But one of the interesting things that it does is it separates financial literacy into two different ideas. One is what is your knowledge of financial terms? The other is application. And we also separate it into four different types of knowledge, four different topic areas of knowledge. So we have basic financial literacy, borrowing and credit, investments, and insurance. So this is cool too because we can test financial literacy in different types of topic areas, and we can test application versus just straight knowledge. Let me just give you an example of a knowledge type of question. This is definitional types of questions. What is net worth? What is the benefit of diversification? And then we have some application questions, and so what you see here is that we've got all four different topic areas and the two different types of questions within each topic area. So for borrowing, actually, a great example of an application question is the insurance question, in which we say which type of life insurance is most appropriate, or who has the greatest life insurance need, and the answer is a single earner family with 2 preschool children. This requires, and our purpose when creating this financial literacy assessment test was to make sure all of these questions were basic financial literacy that everybody needs to know in order to navigate financial markets. And we wanted to make it as unbiased as possible in terms of socioeconomic status and age. We wanted to make sure that each of these questions were just fundamental concepts that everybody needs to know in order to make effective financial decisions. And we would actually kick a lot of questions out because we could come up with a potential bias. For example, this is only a question that people who deduct on their taxes would ever have to worry about, so let's just kick that one out. Well, let's make sure these are fundamental types of knowledge questions. And so when we got the results, and by the way, this is not only what we think the best assessment of financial literacy, it is also the largest now. We've got well over 10,000 people. We inserted in, by the way, I didn't mention this, into the Consumer Finance Monthly Survey that's operated by Ohio State University as a module. And we now have over 10,000 responses. And when we got the results back initially, and this was in 2011, what we saw is that everything looked exactly the way we would have expected it to look. So those with more education scored higher on financial literacy. They have a greater incentive to invest in finance-specific human capital. Those who have more income also have higher financial literacy scores. Again, not surprising at all. As wealth goes up, again, you have more of an incentive to make that investment in obtaining greater financial literacy. So your financial literacy score goes up. But then when we looked at age, we saw this sharp decline in financial literacy in old age. And so that's the genesis of this paper, was us looking at the results and coming up with this conclusion that we weren't necessarily expecting. In fact, what it did at first was make us very worried that there was an age bias in these individual questions. And so that really is the remainder of this presentation, is convincing the audience that there is no age bias that's in fact going on here with these questions, that this is actually something, once you understand the cognitive literature, that we would have expected, and it pretty much matches the decline in cognition that we've seen in other types of instruments. So this is the total decline, and if we look at it by content area, we see that decline in financial literacy is almost identical whether you look at basics or borrowing or investments or insurance. And I'm going to give away one of my major conclusions here. That insurance result right there is one of the most convincing arguments that this is not a cohort bias, because ownership of insurance products was much higher during within older cohorts than it is within younger cohorts. Life insurance ownership was significantly higher in older cohorts than it has been in younger age cohorts. So to see that same age-related decline is not what one would have expected, and that's one of the advantages of being able to have different topic areas in the survey. Okay, so when we were beginning to write this paper in 2011, there were a couple of papers that came out that showed convincing evidence that decision-making quality does tend to peak in one's 50s, and then it does tend to decline at a relatively constant rate each year after that point. And whether it be investment performance or different credit-related decision-making activities, we see that same decline in quality of decisions. And in fact, there's also some convincing evidence that the reason why this decline is occurring is because of a natural decline in cognition. So there have been a couple of other studies that are able to match this decline in decision-making ability somewhat to the decline in cognition. There have been a couple other studies that would suggest, in financial literacy, that would suggest that this might in fact be a thing. Lusardi, Mitchell, and Curto. This is basically, they were looking at demographic predictors of financial literacy, and they stick in a dummy variable for age 75 and older, and lo and behold, it is negative and statistically significant. And there's also some evidence from other studies in the descriptive statistics that it does appear that those who are in the highest quintile of financial literacy, there's a smaller proportion of those who are 71 and older. So if you look really hard at the prior financial literacy surveys or the prior financial literacy research, you see some evidence that this might in fact be the case. And there's actually a bigger literature on this concept in health literacy than there is in financial literacy right now. So I think it's better understood in health-related decision-making that this could be a problem, especially when it comes to probabilistic thinking, that as people get older, they become less able to make high-quality decisions when it comes to probabilistic thinking. So this is really the first to delve into whether or not financial literacy declines in old age and how it declines in old age. Okay, so this is the average financial literacy score by age. And what you see is it follows that inverted U shape that others have found when they've looked at decision-making quality. And if we create a regression where we're controlling for household characteristics and we input 5-year cohorts, what we find is that it's relatively stable in middle age, but you start to see that decline at later ages. And the decline is pretty precipitous. And when you specify age as age and age squared and control for other types of household characteristics, what you see is that the peak occurs at roughly age 50 and then declines slowly from that point. So what we're going to focus on is this period between the ages of 60 and 94. We stop at 94 because we don't have enough sample beyond that point. 60 and 94, where we seem to see something that looks like a linear decline in financial literacy. And in fact, when you do, what's very common in the cognitive, especially the cross-sectional cognitive aging literature, is just to look at the average financial literacy score by age. So what is the average at age 60, 61, 62, all the way up to 94? And then you can actually run a univariate regression to see how consistent this decline in financial literacy is by age. And what we see here is that the R squared is 0.96 when we simply draw a line for average financial literacy score by age. 0.96. That's amazing. That's really incredible. And one of the ways that we can do, one of the reasons we can do this is because we have this sample of over 4,000 people who are in that 60 to 100 or 60 to 95 age group. So we also did this by topic area. And I think that this result is equally as important. And what we find is that the R squared within individual topic areas is almost identical. It ranges between 0.92 and 0.94. So it doesn't really matter what type of question, financial literacy question you're asking, you still see this same very linear decline in average financial literacy by age. Okay, so that's just a univariate model. So there's a lot of stuff. You can come up with a million reasons why older folks might have lower financial literacy scores. I mean, the first ones that came to mind for us is that this is a cohort that has lower levels of higher education. Fewer people have a college degree within this cohort. There are a lot of women, especially in these older cohorts, that relied on their husbands to make financial decisions. And a big percentage of those who are in their 80s and 90s are in fact women, so you would naturally expect financial literacy to go down because of that. There's also the 401k era. And so you would expect that maybe some of these older cohorts would not have as much investment experience, but of course that would affect mainly those investment type of questions and not necessarily those insurance type of questions. So there are a lot of reasons why it might go down with age, which means that we have to do a multivariate analysis, and I'm sure you're not going to be surprised to see what the results are. It is that when we don't control for anything, we see about a 1.3 percentage point decline in financial literacy score per year. When we do control for household characteristics, we see a 1.02% percentage point decline in financial literacy per year. And that's going to become a theme with all of our robustness checks. It's pretty much 1 percentage point per year in score, and our mean score is somewhere between 57% and 60%. And when we specify it as age dummies, we still see this relatively consistent monotonic linear effect between age and financial literacy. All right, so let's look at some of these subgroup analyses. So because there are lower rates of education in some of these older cohorts, let's just look at those who have a college degree. 1.1 percentage point decline per year. Let's just look at males, because we have this issue of females outliving men, and it may be that there was this rational decision to make the husband the primary decision maker for finances. No, it's pretty much negative 1% per year. What about those who directly own stocks or mutual funds? It's negative 1% per year. What if we just look at this older cohort that was age 60 in 1992, and really it was 1992 that you saw that use of defined contribution plans in the United States expand. Now we saw that basically the same drop in financial literacy per year. So it really doesn't matter. I mean, this is one of those cases where in some of these later slides that you'll see are robustness checks that were suggested by a reviewer. It didn't really matter what we did. It was 1% per year. No matter what subgroup we looked at, we got the same results, and the results are the same within topic areas. And again, this insurance category is especially important because that's the one where we should see no age-related decline if this was in fact a cohort effect. And we see the exact same decline in financial literacy score by year of age in insurance. And if you're still not convinced, okay, well, there's 16 questions in this survey. So this is by topic area. This is a logistic, so we're looking at the likelihood of getting this question correct. So for each of the 16 questions, and we use standardized beta to see the relative strength of age as a predictor of getting the question right, the financial literacy question right. So with basics, we've got 3 questions that these were the strongest predictor of financial literacy. This is the 3rd strongest predictor of financial literacy. Borrowing, 2 of the 4. Investments, 4 of the 4, and insurance, 2 were the single strongest predictor, 2 were the second strongest predictor of financial literacy. So there is no one question among these 16 which were intentionally created not to be age biased, not one question in which you didn't see this decline in financial literacy with age. Now, we also, as a component of the survey, we asked people, how confident are you in your ability to make financial decisions within each of these 4 topic areas? And perhaps not surprisingly, we saw that confidence did not go down. We saw a linear decline in financial literacy, but financial confidence held steady. And in fact, in one of the 4 categories, insurance decision making, confidence actually went up with age in financial decision making. And this is a measure where we looked at the 80th percentile and above of confidence and the lowest quartile of financial literacy score as a measure of vulnerability. We call these people overconfident. And it started out about 10%, and it moves its way up to about 1/3 of those who are above age 80 who are in this overconfident category. So you get an impression that those who are in those older age groups are experiencing lower financial literacy, but they're completely unaware that this decline in financial literacy is occurring. Okay, so this is our robustness check. So we looked at the HRS. And it was a little bit more difficult in the HRS because we do have the traditional Lusardi and Mitchell 3-question financial literacy test, and we also have a new module on financial awareness, which contains some additional questions that measure financial literacy that can be incorporated to create a smaller financial literacy instrument of 7 questions. So here's an example of one of those literacy questions. Buying a single company stock usually provides a safer return than a stock mutual fund. And then we have awareness. Are you considering investing in the stock market? That doesn't have a correct answer, so we only chose the ones that have an unambiguous correct answer. We come up with an instrument with 7 questions. But the great thing about the HRS is that it also includes measures of fluid and crystallized intelligence. So we can actually control for fluid and crystallized intelligence in a multivariate model. And here are the results that we get, which are pretty much identical to the results that we get from our data set. So it does go down with age. It doesn't matter if you specify it as a linear variable or with cohorts. And once you start controlling for cognition, the effect becomes much weaker. And actually, when you create different cohort groups, the effect is no longer statistically significant. So we know that once we control for crystallized and fluid intelligence, that decline in financial literacy becomes much weaker. So you can infer that this decline in cognitive decision-making ability is caused in part by a decline in cognition in old age. So some of the conclusions, and I want to very quickly get to a policy implication because that's an important part of this paper. But some of the conclusions are, the one I want to highlight here is that it's very similar to driving skill. With driving skill, nobody knows that their driving abilities are deteriorating in old age. If you ask an 85-year-old, is it getting more difficult for you to drive, they will invariably say no. But when you drive with them, you'll be able to perceive that there has been a decline in driving ability. And when you give them objective evidence, for example, when you bring them into a laboratory setting and have them drive on a simulator and a kid runs in front of the car and you have to measure how quickly it takes for them to put on the brakes, you will find that, of course, they're slower. And when presented with objective evidence that they're losing their ability to drive, they will actually change their behavior. So they won't drive at night, they won't drive in traffic. This is something that I think that all of us, when we approach retirement decision making, we need to think about the possibility that our cognitive abilities are going to decline in old age. And that means that policymakers also need to understand that our decision-making abilities are going to decline. We are going to become more vulnerable as we get older. And that's why things like automation later on in life and simplification become so important. For example, the Treasury now has this QLAC legislation where we can invest in deferred longevity annuities within our defined contribution accounts so that we can provide an automated income that kicks in later on in life. I think this is a terrific idea given the possibility. Well, you know, we're in the defined contribution era. We're placing greater burden on older people to make complex financial decisions about how to invest their retirement assets and how to pull money out of those assets as they get older. If we can automate that, it's going to make the system much more efficient. Let me just give you a very quick example, and this is something that's actually going to come up next year. So the SEC defines accredited investors as those who have a net worth, excluding housing, of $1 million or more. They also have a $300,000 threshold. And there are those at the SEC who are arguing that those who have above $1 million in financial assets have the financial sophistication to be able to fend for themselves and buy unregistered securities, which is, by the way, the wild west of financial securities, and they're oftentimes pushed by brokers because they have very high commissions. And if you have $1 million worth of assets, you can legally buy these type of investments. So this is our financial literacy survey results of those who are accredited investors and those who are not accredited investors. We start at age 60, and what we see is that by the time you hit your late 70s and early 80s, your financial literacy is lower than for unaccredited investors who are in their 60s. And by the way, are these people who are in their 80s more likely to meet that $1 million of financial assets threshold? Yes, they are in fact 213% more likely to meet that $1 million financial assets threshold. And what we also see is, by the way, this is how we would come up with a better definition of what is financial sophistication. But we see that within this group, there is no marginal increase in the likelihood of being an accredited investor among those who are 80 or above who have higher financial literacy. So those who are more financially literate are actually not more likely to be an accredited investor. And that's also the case for those under 40. For example, they have a low net worth and they haven't accumulated, they may have a lot of human capital, but they're less likely to be an accredited investor. Okay, so when we actually look at financial literacy among accredited investors, what we see is that at the age of 75, those who are accredited investors are in fact less financially literate than our reference group of those between the ages of 60 and 64 who are not accredited investors. And by the time we get up to age 80 and above, our predicted financial literacy is way below that of non-accredited investors between the ages of 60 and 64. In fact, the magnitude of the marginal effect is similar to not having a college degree. Thank you.